Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, April 6, 2026. It's 11:14 a.m. Eastern Time as I'm starting the video, so we're a little less than 2 hours into the trading day. And what I'm going to do in this one is a quick update on the equity markets, nothing too deep. I'll go over a couple sentiment indicators, look at crude oil, and a general commodity ETF that I use as a kind of a proxy or what I call the closest thing there is to a real time inflation indicator. That kind of segues into what I'm starting with here. We're going to go over the economic calendar, what to watch for this week that may move the markets besides what's going on in the Middle East or on Trump's cell phone as he fires off his version of tweets. With the economic calendar, we'll get into employment, a pretty brief look at the employment report in the jobs market. There was some commentary. Turned the idiot box on today, meaning TV, CNBC, little pop up you can get on the from one of the trading platforms to just see where the today's numbers came in for ISM. That was the release at 10 o'clock. We had several ISM reports. And before I could shut it off, I listened to a couple of the. They marched out the bull brigade. I'll get to that in a second. Time permitting, at the end, I'll get to an update on Bitcoin, gold, silver, and the dollar. Okay, but if not, I'll cover those in a separate video. So it sounds like a lot, but let me just start here with the economic report. So ISM, we missed on the things that would have helped to beat. ISM, non-manufacturing employment came in, missed expectations by a pretty good amount, forecasted at 51, came in at 45.2. ISM non-manufacturing PMI came in at 54 even versus a little below consensus. This one came in hot again, and this is prices paid. So remember, on the site, if you go to the support page up on the upper right-hand corner, click resources. Then you come into this support center. Down here, you have your economic calendar. You click on that. And right now I have the defaultinvesting.com because you can get a little more granular with the charts. But down on the bottom of the page, where is it? There it is. You can view the Econoday calendar, which is a little more simple, easy to read. So I'm just going to go over this now. These are the things to watch this week. Again, the things that are at least predictable as far as the timing and release of them. Nobody can predict what Trump's going to fire off or when he's going to fire it off. But these things, are coming. So we have this week GDP, jobless claims. It's all on Thursday here. The FOMC minutes, the start events are the ones that can move the market. Obviously, petroleum status report now. People are watching more than ever. Tomorrow, durable goods, personal income outlays, CPI right here on Friday. That's going to be a big one, and we're going to talk about that a little bit. And so, again, there's your economic calendar. You can also go to the other one that we have here, which let me get back to, the investing.com. So when you look at, again, this morning, we have... I needed to jump back there. And so when you come down here, you can go click here for full event details, and that'll load the chart, so you can see what you're looking at. And if you go to max right here, this is again, this is what I call the bane of Powell. What will keep the Fed's hands cuffed, and that is prices going back up. So remember the Biden era of inflation here, and the Fed's in complete denial after they hit the nuclear button when COVID hit and just put too much liquidity into the system, caused runaway inflation, biggest inflation for those of you that kind of might have missed the headlines or were on the moon for the last few years, highest inflation since the 70s in like nearly a half a century. We hadn't seen the rate of inflation like that. And obviously you could see it, we're coming off, they were, nilly-willy with printing money, and every time the market would hiccup, quantitative easing, go back to zero interest rates if they tried to walk it back. And so we were on an era of low inflation. So right now the market is obviously, after that, shock there, more hypersensitive now than it has been, not in recent years, but in recent decades. So you can see the trend up, and we just spiked, hit a new really a pre. This is the highest reading since back then, when inflation, when the the horse got out of the stable there. And so just anyway, that's again, remember the takeaway is the higher the rate of inflation, the more it handcuffs the Fed and takes a few arrows out of their quiver the next time there is a financial crisis, a credit event, or the economy really starts to soften. You really see a big tick up in unemployment, that is. So let's talk on that real quick. So this morning, before I could, before I closed the idiot box, meaning close that window, which I usually do after I get the numbers. They were, again, they were marching out the Bull Brigade, the cheerleading squad, and it wasn't just Bank of America, but they were talking about all the, all the big firms on Wall Street, multiple Wall Street firms. There's on my notes. Anyways, basically just talking about how the job market's in solid footing and everything's hunky dory there. Okay, so again, there were others. Which brings me to this chart. I've shared it with subscribers many times in the past. Really been harping on it for the last, 5-6 months or so, and talking about a simple. Just what I see in this chart. And so basically, we're looking at as far back as the numbers will go. This is directly from the Federal Reserve Bank of St. Louis. So here's one of the Fed banks. So this is these are legitimate statistics. I don't go to Zero Hedge or anywhere else to get my information. If I can get it directly from the horse's mouth, I will. And so, over the past few decades, remember, over time, financial markets evolved. They're a little bit different. Back in the, the 50s, this is, post-World War II, we're talking here. We got a little bit lower. But even then, you can go back to this point. See this red line? This is about the trough in unemployment. And remember, it's very simple, guys. The economy ebbs and flows. It's kind of like the seasons that we have as the Earth revolves around the sun, roughly 365 days for a year. You go through 4 seasons, and sometimes winter is longer. Spring comes a little later. That's why they have Groundhog Day. What's this, Puxahonty Phil or whatever his name is, the groundhog pops up. If he sees his shadow, there's 6 more weeks of winter, that kind of thing. And some of these cycles are a little longer, but what hasn't changed throughout history is the economic cycle of economic expansions, good times, and then economic contractions, recessions or pullbacks in growth. And these shaded areas show you all the recessions, at least the way as defined by the NBER. That's the government agency that makes the official declaration. And so you can see there's always been a downtrend, and when employment gets that low, you're going to have these bobblehead. Because again, guys, please understand, that's my background. I was a career stockbroker. I was in that industry, and I understand the absolute critical nature of them being permanently bullish. Their whole business model revolves around assets under management, pretty much, and so they need to keep people, bullish and their accounts in stocks and equities. They don't make money when you pull it out, go to the bank, put it in a CD or bury it in under your mattress with gold. And so just know that, just keep that in mind. So you have to be a little skeptical. And but when I see this chart, again, there's really no variation. Sometimes, and we had a period here where this was about the magic number, where for a couple decades, that's about as low as unemployment got. But the simple thing is, where I see a trend where once there's a clear inflection point, not all these little bumps you see are just minor squiggles within a trend, but when you see a clear inversion, after something is troughed without any variability. Once you've started going up, and again, you're looking at decades on this chart. Each span right here is a 5-year period. So when it's been a year or so where you've clearly seen an upward trend, in virtually, I don't see any instances where a recession hasn't followed. So again, it's might be counterintuitive. I view the fact that I can clearly see we troughed right there. We troughed where we have troughed before, and we've clearly been moving in the wrong direction. Is the unemployment rate historically low? Absolutely. Has it turned? Has it clearly, without having to squint to see? Let's drop down a little closer here. Has it clearly turned the corner? Yeah, it has. And so, yeah, again, this time may be different. Those are dangerous words in the market. This time is different, but there was a recession. That was COVID. If you blinked, you missed it, but it was technically a recession declared by the NBER. And of course, the whole world shut down. It's a quick one. But that's it. So I just wanted to say that, and for what it's worth. And what that does, that speaks to the bigger picture. It doesn't speak to how I'm going to be positioned today, tomorrow, next week. It kind of formulates where the economy and the market are likely going. Because if we do this, that's going to be a first. If we go down, and we've seen such a clear inflection. It happened very quick with COVID, but it was certainly an inflection. There was your V right there before the recession started. I guess my takeaway here, guys, if you're waiting for Kramer and Crude to tell you that we're in a recession, or to come on and tell you that NBER has officially announced a recession, well, there's a couple things to that. Number one, they use the old standard definitions, two contracting quarters of GDP, right? Two negative back-to-back quarters. Well, GDP is full of revisions. Every GDP, you have initial preliminary release. They come back, revise it. And so what I'm telling you, and I know this from experience, by the time the NEBR comes out, by the time Kramer and Crew, Fast Money, whoever tells you you're in a recession, your 401k is down 40-50% at that point. You've missed most of the drop in the stock market, which has long since priced it in. The stock market has always had the ability to look out 6 to 9 months ahead of the economy and kind of see what's coming, right? So that's it. Let's move away from that. Then there's this one. Right after that, they had the CEO of CBOE come on and talk about just an outright explosion. They've seen growth, but just a huge explosion in the last few years of options trading among retail traders, especially in those ZDE, the 0-day expiration options, which are pure gambling. You buy an option that day, you're betting if the market's going to close up or down, or if stock's going to close up or down. And to me, that is the absolute purest form of gambling. And it just says so much. If I have to explain why I think that, we are at the, this is similar to kind of a 1929-ish situation, more so than I think a 2007 or 8. Again, that's not a timing indicator, but it just speaks to what's out there. Not to mention, and they talked about it here, all these new gambling platforms that have come out, betting platforms. You can bet on whether it's going to snow next week or what Kim Kardashian is going to say at the Oscars, that kind of shit. And that's, again, the mindset where we're at right now. And, the financial markets, the stock market was originally created, and it should be for investing, for you buy companies, you believe in the long-term track record of those companies, and or the long-term growth potential, and you're going to make money. The stock market has become a casino, is what I'm trying to say now. And if you think that ends well, then keep going, keep gaming the casino. And again, guys, I'm talking long-term stuff right now. We're going to get to the charts with precision here in a second in this video. And then he went on to say, in more than one occasion, and he didn't say it definitively. He kind of implied that he thinks most retail customers are profitable with these ZDE, 0-day expiration options. And they have I think it was a new butterfly product, a new options product coming out, that in his view is going to be in line with their views that the majority of retail traders are going to continue to be profitable. Okay, let me just say one thing, and I'll leave it there and we'll move on. the house always wins. You go to Vegas, if the customers are a majority of gamblers that walk into a casino win, the casino goes broke, that industry doesn't exist. And if more retail traders are winning, there's in the stock market they call it the dumb money and the smart money. And historically, I've heard this said many times, is retail traders, which they refer to as the dumb money, and professionals consider the smart money. Dumb money buys options, smart money sells options. Most of you listen to my voice. If you use these, there are strategies you can mitigate risk and straddles and combinations and butterflies, all that. But pure put and call buying, they tend to be done by the retail traders as just a leverage bet. 100 to 1 leverage on a put or call contract represents 100 shares of stock. You can leverage is insane. Yeah, I don't have to tell you if you've done it. And so historically, it's the institutions that are on the other side of that trade. Every time you buy a put or a call, somebody has to sell it to you. And smart money knows the vast majority of options expire worthless. So I just zero credibility in my opinion when I hear this kind of thing. The whole system wouldn't exist. Retail traders, if you're a long-term investor, you make money in the stock market, like Warren Buffett. Put away for 20, 30 years, you're going to be up. But you start, again, there are some, don't get me wrong, that's what we're here to do, is try to beat the market actively trading it. But I'm just trying to say that, and options aren't my thing. I just wanted to say I take that to me, and again, more so the trend, the proliferation of all these gambling tools. Again, zero-day options are just pure speculation and gambling. It's not. Options were created initially as like futures contract for professionals, and it's to hedge. If you're a farmer and you got a crop, you got wheat coming, you want to buy wheat futures, or airlines will hedge using crude futures. Same thing. Institutions could hedge with options. You have a lot of stocks. You're expecting a possible pullback, but you don't want to sell your holdings and generate tax liabilities and the fees. So you buy some puts to protect some downside, and that's what they were initially rolled out for. And they've become, again, I've seen the market evolve into a casino, especially since COVID, when all that liquidity and stimulus was injected, and everybody got paid to stay at home and gamble on meme stocks and crypto. That's where it all started. By the way, a lot of economists, if you really want to get granular, they'll look at U6, which is a much more, in my opinion, accurate representative of kind of if you want the closest thing to an accurate government, report. Some are very flawed. And that's total unemployed people plus all persons marginally attached to the labor force plus total employed part-time for economic reasons. Those that instead of just trying to get on the government dole and collecting or don't want, it's not enough to get unemployment, they're working 2, sometimes 3 part-time jobs because they can't find a full-time job. And as you know, part-time jobs typically don't come with benefits, so like health insurance, 401ks. And so that has run recently, spiked as high as almost 9%. So, and again, the trend, the inflection is clearly in, the bottom's clearly in. You can see what's happened before when it inflects. I'll just put the little red arrows at the trough and then start going up. And again, COVID was very quick, but here you can see it takes a while. Again, trend down, you hit the bottom end of the range, and then you start trending up. And then invariably the recession follows. So it would be very atypical to see this, or to see this even, continued for the next couple of years, Goldilocks type, a low unemployment. But again, not an exact timing indicator. We're about to get to those levels here in a second. Okay, something else I watch closely, and it's been... really hasn't been even a yellow flag, but we're starting to finally see it tick up to be that, and that's credit spreads. Credit spreads are the differential between what investment grade, high quality government bonds are paying versus below investment grade, what they call junk bonds, low high yielding bonds. And at different times back in after this was the dot-com bubble, this was the recession that followed the dot-com bubble. So it was clearly, you could see the market was at that point in time, it was clear to the credit markets that it was the retail traders that thought they had it all figured out and were making money hand over fist buying anything with the name .com behind it. And Pets.com was kind of the poster child of that. Then we had that 80% drop in the NASDAQ once the market crashed. And but after that point, we went into a bull market from there, and credit spreads went down. And there's a level, and they based here, and this was the magic number about right here, this level. That kept coming up to that. And then they took it out just before. That was right when the market topped. I remember it was October of 2007, and we broke above the recent resistance level. And that was the range back then, the trough. And this was the financial crisis that followed. Credit spread surged. Since then, this has become pretty much the cap, if you will, right about this level here. So that's the level I'm watching. We're still well below it. Remember, over every market cycle over the years, when this holds true to the VIX as well, it has different floors, if you will, different bases and bottoms or tops. But this seems to be about the magic number right here. And so that's something to watch for when that breaks loose. Now, I can tell you, looking at the very near-term trend, that was one thing that really until recently wasn't flashing a lot of warning signs. It did back here, and when we were short the market. Remember, we shorted well before liquidation day when Trump stepped up to the podium. We were already short, and we covered the April 6 lows, April whatever that bottom was, reversed it long. So we did have a spike up there, but you can see they have now been trending back up. So the current trend, we've finally seen it reverse. We're starting to see risk pricing back into the market. And as I've said for a while, and I've maintained, and even Jamie Dimon said it, he believes that that credit spreads are not pricing, and they're lower than they should be. Let's just leave it at that. There's also some distortions in it. I think it's a little tougher this time around because I won't say the first time in history, but for to the biggest extent that I can recall in history, finally, the U.S.'s deficit spending and kind of the manipulation that the Treasury's been doing, even before Yellen was doing it, issuing, rolling over debt on the short end of the yield curve, because pardon my French, the U.S. is kind of fucked. Unless interest rates come down, you can read up on this, our interest cost is spiraling. So not only is this the first time in history we were running deficits at levels only seen in history in the U.S. or during times of war. You want to call Iran a war, but that was long before that happened. So we have this deficit spending going on with stimulus packages and tax cuts and all this other stuff that is normally reserved for times of recession. So the bond vigilantes are stepping up. And as I've talked about, the biggest problem there is this is what's happened. We've had, since rates troughed when COVID hit, we've had nothing but, and in my opinion, and I've made the case, unless you're new to the site, you've heard it 100 times, every single metric that I use in technical analysis tells me that we've ended what is known as a secular bear market in interest rates, falling interest rates defined by this price channel, downtrend line, these big drops here, and here were quantitative easing, and then that was the nuclear button hit. And so by every metric, including the fact that uptrend is simply defined as just like a downtrend is lower highs and lower lows. That's the definition of a downtrend. An uptrend is defined as any security making higher lows and higher highs. Right now we're consolidating. If we do this, as I said before, I see no other way than it being anything but utterly almost catastrophic to the stock market. And remember, the U.S. has massive amounts of debt. That's how we pay the bills. That's how we keep the lights on. That's how those F-35s are getting fueled up. And God knows how many millions of dollars each plane costs. And all these Patriot missiles we're shooting over, all that stuff. War ain't cheap. No, nor is in fact half the country's on food stamps, and a lot of them government assistance, and on the welfare dole. Social Security is almost bust. So all that stuff goes in there. I mean, don't get me started. But again, it's manageable, just like for your neighbor who's driving the Lamborghini or whatever, the Range Rover and three Mercedes and all that stuff, but yet only making a couple 100,000 a year, trying to live the life of Riley. When interest rates are cheap, that's fine, but all of a sudden the lease is up, you got to go renew, and now the internal rate of return on the lease or you buy the car is now 8, 10%, 12%, and that's the same thing that's going to happen to the U.S. here. If this we break out, and the problem too is they've been playing that dangerous game, like I said, of rolling a lot of treasuries. These longer term treasury bonds are coming due, and they're doing the new issuance on the shorter end of the yield curve, and even that's been starting to work its way up. This is just the 30-year. You can go look at the 5-year yield with FVX and see the same thing. So corporations and the federal government have just been gotten used to these ultra low rates for the last this is 2008, guys, right here, the financial crisis. So everybody, individuals, corporations, and all that have gotten used to those uber low yields and are expecting that to refinance here. And even the CBO, their projections, the Congressional Budget Office trying to project where our deficits are going to be, and they're all assuming these low rates. God forbid that I'm right. Just let's hope I'm not. I mean, for the country's sake. But if I am, and again, the timing on it, well, that's a whole nother video to get more precise. Me, I love trading treasuries, long, short. We're batting probably 800 or better in the last couple of years on our TLT and ZBE treasury trades. But this can go down first. And it will probably, if the stock market were to have, let's say, a sharp down, a crash type scenario, a big drop. But ultimately, and even if it came in here, if it took a couple years, back tested the channel, my long-term outlook is that we're going to go here. Now, if it happens sooner, again, that's a get out of Dodge moment for the stock market. And again, it's going to just clobber, annihilate businesses that were used to and expected to roll that debt. Businesses most of them don't do the 30-year bonds. They do, anywhere 4 to 7, I think, is the norm for small caps. 6 to 8, somewhere in there is the average maturity, I believe, for large cap companies. And so they're all starting to come due at this when they were expecting to come due down here. And so again, this is a function of two things, as I've told you. Same with crude oil, how high we go, or how long we stay elevated. This is the best case scenario for the market, but if that scenario comes with lower rates, considerably lower yields, if it's organic, natural forces, the economy's holding up, then that's good. Now, you can't argue that lower interest rates are healthy for the economy. But if it comes as a flight to safety bid because the equity markets are blowing up and pension funds are starting to cover cut their risk, and selling stocks is a vicious cycle, the margin call, the debt bubble, everything I've talked about before. If you're new to the site, let me know. I'll give you a chart of the FINRA margin interest and show you that how that correlates with stock market cycles as well. And then it's that unwinding effect. Selling begets more selling. So let's dive into that. Let's get to the markets. Before I do that, there was one more. Okay, I covered that one. Wall Street was bullish. I covered this one right here. Yeah, I drew it out. That was the credit spreads. And I had one more. Yeah, this guy, sentiment. So they marched out this guy, HSBC's chief multi-asset strategist, who called a bottom in the market, a recent bottom. And again, that's probably showed you a lot of charts, big positive divergence on a lot of the big Mag 8 stocks, key sectors, divergences that I think are probably going to get burned through on the daily chart because of the technical posture on the longer term weekly and monthlies. But with that being said, again, like I said, it was a complete march out of the bull brigade between the CBOE, head of the CBOE, talking about options and how retail traders are making more money than they're losing, which again, it's like Las Vegas Sands or the whole Vegas casino industry telling, most of our gamblers are making money. The bottom is most likely in because sentiment measures have hit buy signals. Let's go over that. And because I've had a subscriber that's talked about that too. Yes, obviously, guys, there's been a spike up in a bearish sentiment with what's been going on in the stock market dropping. Those go hand in hand. But I'm going to get to that right now for you. Okay, one of my favorite indicators. I have several sentiment indicators I follow. One of my preferred is a CPCE, which is the equity only put to call ratio. So you don't have the indexes in here. Indexes, a lot of the index put and call buying are institutions hedging. You have a lot of retail traders that will game and play individual stocks. And either way, it's one that I've been following for years. I do follow all of them. The CPCI, which is the index only equity put to call, index only put to call ratio, I should say. In the CPCE, which is the total put to call ratio, that's all put call buying, and then this one, the equity only. And it's pretty simple stuff. Green zone is extreme fear. You at that time you look for buy signals, and that comes on breakout, pullbacks to support. Any of my price targets, I look for positive divergences, bullish chart patterns, a bullish engulfing or bullish reversal candlestick patterns, et cetera, et cetera, et cetera. So, and as you can see, when you hit, they're all circled. The little circles up top here. Let me clear my annotations. That's it. This is where I look to cover shorts and to go long when we visit my green zone. I've had that for many years. It's pretty simple stuff. You can see where bottoms come. Well, we were pounding a bottom out here. You had multiple. Again, what you're showing when you get to the green zone is extreme fear. That's a lot more put buying. That's what this line is, than call buying. And so even we had the first correction after the bottom was in and a big drop, and we spiked into it again. Said buy that. Too many people. This is when people are afraid. So what I've said many, many times over the years, I've been using sentiment indicators for decades. They're completely, utterly worthless. I'm going to reiterate what I just said. Worthless when they're not at extremes. Anything in the middle here, I've learned, doesn't mean squat. You're going to get this spike. This is what the guy was talking about on CNBC. This is what I've heard some at least one or more subscribers say recently. We've seen this pop up. That's the norm. Once the top is in, you get that, and sometimes it can end a correction. But from my experience, anything but extremes are just noise. And so if you want to increase the probability a bottom or a top is in, then you look for a move up to, again, you want to buy. This is extreme complacency. And in recent years, just like leading up to the top, the bear market of 2022, you had a cluster of readings. And it's not unusual, and that's what you had here, a cluster where you're kissing multiple taps of the red zone, and now it's finally starting to manifest. So that's a prolonged period of extreme bullish sentiment. That's what the red zone is. It's extreme complacency, meaning a lot more people are buying calls than are buying puts. So I just wanted to address that and say that all we are right now is in no man's land. Yes, obviously with what's gone on Iran and of course with the stock market and private credit and all that, yeah, you're going to see a spike up. Could it be the end? Maybe. I don't know. Probably. But it's I don't put anything into that. That's completely normal. And again, and more so, we're coming off this extreme, just like we came off that one, then followed the 28% bear market in the S&P right there in 2022. All right. And he had cited that. He also cited this one. This is the AAII, bull to bear ratio. And so what that is, it's a weekly survey from the American Association of Individual Investors, a well-watched survey. But it's what I call the CPC, the put to call ratios, like I just covered. I call those the money where your mouth is ratio, and they're a little more reliable because that is actual positioning. This is a survey that goes out and asks these money managers, are you bullish or bearish? Do you plan to buy or sell, in the next, whatever period of time? And the reason I call it a rhetoric indicator, not a money where your mouth is, because you can be foaming at the mouth bullish and planning to buy. But one of two things. Maybe you're fully invested already and you don't have any more powder to deploy, or something changes your mind. Something pops up, something like war in the Middle East. And so you don't end up buying, right? So there's no guarantee there. Now, what I've noticed in this, although I do have a red zone, this is where everybody's getting bullish, and this is where everybody's getting bearish. The extremes down here, you can see this is where bear markets end when everybody's bearish, bear markets end when everybody's bearish, but it's not a timing indicator just like the other one. These are conditions. Sentiment, extremely bullish or bearish, is a condition, not a singular instantaneous buy signal. But what I have noted, and I picked up on this only a few years ago, is that the biggest corrections in bear markets typically come well after bullish sentiment has peaked on this indicator, and shortly or immediately after the AAII bull-bear ratio has crossed into negative territory. So you can see here, right? Everybody bullish, and the market kept going up. That was it doesn't look like a lot. It was a nearly 18-month sideways deer market with two big corrections within it. I didn't have this in log scaling, so it doesn't look like a lot, but they were in some indexes, they were over 20% drops, guys. They were actually bear markets in the small caps, I think the NASDAQ. And again, not using log scaling, I'll have to just change everything and redo the whole chart to flip this. It's linear scaling. So in other words, there's there's the financial crisis, which is 55% drop, one of the biggest bear markets in history, really. And it doesn't look like a lot. So I just want to let you know that these are big drops. The Q4 2018 drop, COVID's right there, 36% drop in the S&P. And again, you can see my arrows. So this is my analysis. It's it's a little deeper than some. Some just say, oh, because everybody's getting bearish now. Well, the tops come after the period of bullishness. It's when you flip to bearish, not the extreme. Unlike the put to call ratios, again, the money where your mouth indicators, this is sentiment. And it hit me a few years back that it's after everybody's been bullish, and when they start to get bearish and you see it fall from the big black hills, these big extremes, that's when the bear market starts. So or the big correction. So far, it's certainly worked. The $1 million question, is it over? Was it just a good signal for a correction? Because we did hit a 10% correction, minimum threshold in the S&P. Or, like my question marks have, is it the start of much more? And at this point in time, that's still what I maintain. Okay, now on to the charts. All that, again, I want to get that stuff out because I cover the charts every single day. You have static charts, meaning screenshots. I have made a ever so slight tweak this morning to my downtrend line because I zoomed in. I wanted to make sure I captured the reaction high. So there's the high right there, double top high in the NASDAQ 100, QQQ. And I wanted to come in and capture the top of both those candles. And still, this is my bounce target range. Remember, we hit it last week right here. We hit it again. I highlighted both days. And I have a bounce target range from when we hit my T2. When I zoom in, these numbers move. That's T2 right here. T1 was hit back here. Highlighted that as an objective level to cover and game a bounce if you're an active swing trader. And I gave you a bounce target that went from right here, from the bottom of the trading range, which is also the 200-day moving average, which we hit twice last week. We're pretty much on it right now after trying to get above it today. And then as I zoom in a little closer, we also have just above it the 200-day simple moving average, the blue line. So the red is right here. Here, I'll turn everything off. Exponential, 1, 2, third day testing it. If they take it out, now they have to contend with the other half of the world that watches the simple instead of the exponential. That's why I watch both. And that's also often acts as support and resistance when tested from below or above. And then you have the 50-day, which is this yellow line right here. I think you can see my 50-day moving average. I use an exponential. You can put both up too, but I don't want too many lines on my chart. It's bullish when you're above it. It acts as support in the near term, and it's resistance when you're below it. So that's why I have this confluence of resistance in addition to the downtrend line off the highs. So I want to reiterate what I've said twice last week, both on Wednesday when we first hit it and Thursday. Remember, the markets were closed Friday for Good Friday. That this is, as I speak right now, an objective short entry, add-on, or re-entry for those that booked profits and or game the longs off T2. Hard stop. And my plan has not changed. I see absolutely no reason. It's scale up to, leave a little dry powder. I told you I was going to go into the weekend light because it's a 3-day weekend, and that's at up to, but not above, and not stop out immediately. But if we get a solid daily close above there, yeah, and then scale out. And beyond that point, I will most likely, if we take out the midpoint of the trading range, either be at that point net long or out of most, if not all, of my shorts by then. So that's kind of a scale out, hey, something else is going on zone. Now, let me show you one other thing on that too. It's kind of hard. Sometimes the stops will get blown. They know where they are. Like I just said, everything I just listed for those reasons are very logical and reasonable stops. So you go back to, the last bear market we had in 2022. We were also short off those highs. We had an almost identical situation as I was highlighting back then, a trading range. Here, I'll zoom in for you a little bit closer and we can go get tight on it. All right, I paused the video to get a tight zoom in. We had a trading range, one which I predicted if any new high would be a marginal new and still divergent high and fail. We popped it in the S&P, made a marginal, meaning slight high. QQQ made basically an equal high like last time and still divergent high, and then boom, from there we went down, and we gamed that thing with impunity. We gamed both these counter trend bounces, or at least they were setups to, we had positive divergence, and they were bear market rallies. And that's what I said. Once you put in positive divergences in a bull market, divergent lows are typically and almost always the catalyst to new all-time highs, but in a bear market, they're good for counter trend bounces. 17% bear market rally and a 24% bear market rally. I have it measured there. And then that one did it. And then recognize that. And on January 1st, this is where the majority of the Mag 8s, I said hard long favorite. My two favorites, I believe, listed as Apple and Amazon with an overweight on the Mag 8s. So in other words, QQQ. And QQQ vastly outperformed the S&P 500 from there. And again, it was all technically induced. A lot of things saying that, that one had run its course. And the 200s were taken out, back tested, and the rest is history. So my point is very similar technical posture. And back then, we took the 200s out, we back tested them and got rejected. We back tested, got rejected. But even in other sectors like the ones I've been watching, including the financials, let me go to that real quick. Show you something here. So remember, the S&P until recently was making all-time highs, yet the NASDAQ had already peaked. Private credit had blown up. That was started predicting that back in early August. And then here's XLF. XLF has one downtrend line I have here. It's taken out another one right there. Still well below its 200s. And like I said before, it doesn't have the weighting that tech does, but it is the second largest sector of the S&P 500. And it is very important, kind of gives you an idea on what's going on in the economy, because I think this time around, a lot of people are worried about AI. Is AI a bubble? Is that it? And all eyes right now in Iran. But, I think this is a sector that's going to need to continue lower to take the market down. But it peaked, had a, nice healthy drop, down 15, 16% from that divergent high. I gave a lot of check marks along the way. And look, it could bounce. It's got a ways to go to get back to the 200s. In fact, if we go back to that period back here, let's do it again. Let's take it back, 2022. You can see we did the same thing. We had a little trading range. I had a box for you back then. This was the trading range. We broke out, made a breakout to new all-time highs at the time. It was a divergent high with negative divergences, overbought conditions. So as I say, breakouts that occur with negative divergence and overbought conditions have a higher rate of failing, and it did. But look at that first kickback. Well, that was when we hit the 200s. We had a nice snapback rally. Then we lost here. Can you see everything here? I'll turn off the lines. We lost the 200s And so that was a very bearish signal, a flip. And we set up and we had a rally. We had a counter trend bounce. It took back the 200s for about a week or two, but then it failed. And that was lights out. When it failed and the masses realized the financials had a lot more downside to go. So again, what I'm getting at is we'll keep it very simple. I will reiterate, my trading plan hasn't changed. You guys do you, I'll do me. That's what I always say. I provide analysis. I do not pull the trigger on your trades. You don't pull the trigger on mine. Mine's the scale in. There's the S&P 500. I just showed you QQQ a minute ago. That one is at its downtrend line and currently testing the 200-day exponential moving average for the 1, 2, 3rd trading session in a row, Wednesday, Thursday, today. Downtrend line. If it happens to pop it still has the 200-day to contend with. And then it has the midpoint of the trading range. So anything above there, in my opinion, it's going to be pretty damn bullish. But right now, that hasn't happened. Right now, I can tell you with a high degree of conviction and confidence, we have a wall, a very significant confluence, I should say, of resistance. And that's it. So I believe this is an objective short entry. Now that is whether it's an initial entry, a re-entry for those that book profits at the recent targets that were hit, or a new short entry because you, whatever reason, were a non-believer up here, failed breakout, the break below the trading range, break below the 200s. Again, it's been nothing but check marks for last few months now. That's all I can tell you. That's my 2 cents on it. We do have, I said Friday, CPI coming up. DJP is one of many commodity tracking ETNs. It's an ETN, similar to an ETF, just get a K1, but I'm just looking at the prices. I've used this one for years with you guys to make predictions on the CPI. Now, I know there's a lot of criticism on the CPI. There's also been a lot of government shutdowns recently, and data's kind of been wonky. But and the final thing is, I often say this is the closest thing out there, in my opinion, to a real-time inflation indicator. Housing is the biggest component of the CPI, but the Fed's preferred use PCE, I believe it's crude, if I'm not gasoline prices, I think. And crude has a big impact on all these broad-based commodity ETNs. And crude is, again, make no mistake about it, the single most important thing that we can measure minute by minute. Remember, the CPI doesn't use the price of homes. They use owner's equivalent rent, which is basically what someone who owns a house could rent it out for. It's just how it works. And then you also have Zillow. So everyone's looking at their Z estimate, but that's very lagged information. Your Z estimate doesn't have a true reset. It'll go up and down, it'll fluctuate, but when your house sells, so if your house today tells you it's worth $1 million, you try to list and you find out it's not moving at $1 million, and you sell 18 months from now at 800,000, that's what the price is going to be. So there's quite a lag time there on the real estate market. There's really hard to get a real-time indicator. You can see here, crude has just gone, commodities in whole, and this includes everything. Everything meaning energy is energy is a big part of it. Back in 2024 is 30%. Grains, oilseeds, precious metals, industrial metals, soft commodity, livestock, everything in there, and all that stuff eventually permeates into the CPI. A bushel of wheat, what it goes for isn't in the CPI, but a loaf of bread is. So if wheat and corn keep going up, things are going to go up at the supermarket. If beef keeps going up, live cattle, lean hogs, it's going to affect the what you pay for a steak or a pork chop, right, or eggs. So this stuff will matter. And again, I've used it with pretty good success over the years, and kind of, and so you can see where and there's a lag as well. So you're going to get the CPI that's coming out on Friday is going to be for the month of March. So that's here's March right here. This is March, roughly this box. So you tell me where the CPI should come in at if this is what commodities done. Now, again, I just spoke to the fact there's a lag. Wheat can shoot up 20% And wholesome bakery may not raise a loaf of bread right away, but when you have persistent, you can see this trend. We've had nothing but inflation surging up, and it's not just crude oil. There's a lot of agricultural commodities and other things in there that will translate. So eventually, and the longer the CPI excludes that and ignores it due to the lag, the more powerful, the more caught off guard Wall Street's going to be. So I just want to tell you, if CPI comes in cold, then it's just complete BS in my opinion. You can see what's happened there. And if it does happen to come in, at expectations or a little cool this month, well, then that lag that's already been built in is going to hit next month. So anyways, watch for that, guys. It's on the calendar, and that's my guess. This is probably, what, I have to look at consensus. I didn't even do that. So if the consensus is already pretty high, but again, remember the Fed, their hands are kind of tied for what I said. The hotter inflation comes in at, the more it handcuffs the Fed. This market is on bended knee right now, literally on bended knee, praying for Powell and the Fed to come in and ride to the rescue like they always have. You have the Powell put, but again, I told you he's been castrated to a good extent. And you had the Trump put, and that's starting to lose its impact too. As I said, the whole taco thing, because he's so erratic with his and backpedals all the time. And I've showed you a recent pattern where the market is reacting less and less to his, shenanigans, if you will. Okay, I think I'm going to wrap it up with here. I already talked about crude. This segues in. I'll get to the rest of the stuff, gold, Bitcoin, all that other stuff later. Cover the market. And again, this is both a recap for those existing subscribers or anyone new to the site. This chart, I posted this, what was it, at least weeks before the first bomb, missile, anything flew in Iran, right? Before crude shot up. And I gave you a level that I noticed, a magic number, about $78, that when crude is low, rising crude prices don't matter when crude goes from $30, $40 a barrel to $50. Nobody cares. Gas goes up a few cents. It's absorbed. There's not an impact. But this, when the economy is used to low energy prices and you hit that is where in just about every instance, either the red lines, the biggest corrections and or bear markets in decades have happened when crude prices have been low and they hit that 78 level from below. You had a little correction there, then came a bear market. The market couldn't absorb that, and that was a part of it. And yes, guys, I understand the financial crisis happened, but there's always a trigger. Those shenanigans had been going on in the housing market for years. And what happens is when a catalyst, and it can come out of anywhere. In this case, it could be high crude, credit event. I think there's a lot of potential catalysts. It just puts the brakes on the market. So there was the biggest bear market, and they call it the Great Recession, 55+% drop in both the NASDAQ and S&P. Crude kept going crazy. Didn't help. Government came in, hit the nuclear button back then, quantitative easing, and oil crashed due to demand destruction, right? Then it got back. It kissed the 78 level, and we had the biggest correction in years after the financial crisis. Let me try to pull it down here, and you can see the years. There you go. Now you can see the years. So that was the biggest correction there. The market got used to it. There was a lot of liquidity stimulus. And remember, we're coming fresh off a bear market. Valuations, what does that mean? Valuations were reset from extreme highs in the Shiller P ratio and all valuation metrics to extreme lows, meaning stocks were dirt cheap and the system was flooded with liquidity. And again, so it's when you're coming from below, that's when the drops happen. Low crude kissed my $78 level. That was the Q4 crash of 2018. We shorted it at the highs, covered right off the lows. I called for the backpedaling. That was when the Fed tried to walk back and get away from their zero rate policy and started a rate hiking campaign. I predicted the stock market would throw a hissy fit, and it did. And then the Fed cowed down and reversed course there. And that was it. But it also coincided. See, all this stuff comes together, guys. That's why I do these long-winded videos. The more of these parts, I always use that analogy, like trying to a prosecutor trying to convict in a criminal case. You have to prove the defendant is guilty beyond a reasonable shadow of a doubt. So you got to come at it with a lot of evidence, or you're wasting your time and the court's time. You're not going to get a conviction. When shorting a bear market or trying to a bull market or trying to call a major top, you need a lot of evidence. That's why I do these long-winded videos, and this is it. So again, low crude, hit the level there, kiss my 78 level. We had the first bear market. Technically speaking, it was over 20% drop in the S&P since the financial crisis right there. And COVID was 36%, but again, that crude had complete demand destruction there and didn't matter. Again, we came under, we kissed it again, correction. Got low below there, kissed it again, bigger correction. And we got even lower. And what did we do? We hit it there. Again, that was before the Middle East conflict. And I highlighted at the time, we were already short the market for those reasons. Iran was just a fundamental thing that was in the works. It doesn't matter. It really doesn't matter. It mattered that this told us. And as I said, this is where we're at now. And it's a function of how high we go. If we go higher, like we did, even though the recession had already started back then. Again, the NBER didn't tell you until here, sometime in '08, right around probably Lehman or so, that, hey, we're in a recession. Everything they kept telling us, all the CEOs of companies, just like now with private credit and the bull brigade, they're marching out on CB. They're telling you everything's fine, the economy's fine, the job market's fine. That is their job. Their livelihood depends on that. Their bonus, their house in the Hamptons depends on that. They must and will do that. And whether they believe it because they're brainwashed too, or they just know they have to, come out and sing that song, that's what they're going to do. And remember that I go mainly off technicals. I certainly value, and this is fundamental. This is using technical analysis to identify where crude becomes a problem, but it's fundamental analysis because the impact it'll have on the economy. So if for nothing else, if I'm right for the wrong reasons even, and we go down, this will be a vicious cycle, because right now the wealth effect is what's keeping this economy chugging along. Despite the tariffs and all the volatility and all the whipsawing with what Trump's been saying and doing with tariffs and all that other stuff. And then selling will be getting more selling. I'm going to wrap the video here because I'm almost to the hour mark. But again, I've shared the chart and you can pull it yourself. Type in FINRA, FINRA, margin debt. Pull up a chart. Make sure you get one that overlays it with the S&P 500, and you'll see what happens. The stock market goes, reaches that. The debt, the FINRA margin debt, goes almost parabolic there at the end, meaning everybody's just loading up because they're making so much on Nvidia and semiconductors and crypto, and then they start leveraging their portfolio, including institutional traders, by the way. They use leverage too very much, hedge funds and the likes. And then that reverses, and it's a vicious cycle where selling then begets more selling due to forced margin calls. And so if that happens, and then that in itself, I don't think you'll find an economist in the world that will not argue that a 30, 40, especially 50% pullback in the stock market in itself will not trigger a recession, simply because of the wealth effect. All right, so that's it. So the levels you have to watch, I already gave you objective reentry levels, but if you want to wait, be the in this case the second mouse to get the cheese at this point. Like the guy that was on CNBC today that I said called for a bottom in the recent lows. If those recent lows get taken out, there's going to be a lot of stops in long side traders that bought that. And that was T2. Remember, that's where we covered reversed. And so this is my preference to short high. It's like buy low, sell high in reverse, right? You want to buy a stock cheap on sale. You don't want to buy a stock high. But in shorting, it's the opposite. So that's my plan. Scale in there, but then once that gets taken out, you'll probably see a swift move down to T3, and then again my longer term targets on the weekly chart. We go up here, I'm not going to be shorting. I'm not going to add. I'm not going to dig into any type of hole there on the trade. The shorts I started re-entering into last week. I'm going to hold tight and be out by that, once that 614, if and when that gets taken out, we'll most likely be out. But again, I'll look at it at the time. I can't tell you what the 60-minute charts are going to look like. I can't tell you if NVIDIA might break key support, which then can have a ripple effect on the semis. I can't tell you if there's a credit event comes. Those are all the things that, again, my analysis, the markets are very dynamic, constantly changing, and so is my analysis. So that is my current plan. And like any trading plan, it's subject to change. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.